Perspective now from Royce Mendes on the U.S. and Canadian economic picture. He's managing director and head of macro strategy at Desjardins. Royce, nice to see you. What was your reaction to the U.S. inflation data?
This was unambiguously good news for the U.S. economy, for consumers in the U.S., but also for Canada. It means that there will be fewer inflationary pressures showing up in North America overall. We know that at the height of the inflation crisis a few quarters ago, about a third of excess inflationary pressures in Canada were due to spillovers from the U.S. So this is great news for the U.S., but it's also great news for Canadian households. It means that there's going to be less spillovers. It's going to make it easier for the Bank of Canada to eventually get inflation down to its target.
That's a great point. Actually, no one's been talking about that recently, but the idea that at the peak of pricing, especially when you do the currency translation, right, people in Canada that are buying stuff from the United States, that really stings the pocketbook. I mean, in terms of, do you think this could then indicate that the inflation reading that we get in Canada for July heading into, a week's time could also be relatively encouraging?
I hope so, and I think that, it looks like early indications are that we'll get a reading that would be consistent with slow but steady progress. I think we're at this second phase of the inflation fight. The first phase was pretty smooth, getting inflation from above 8% down to roughly 3%. The next phase is going to be tougher, and I think inflation's going to sit around 3.5% for some time. But that doesn't require additional rate hikes. What it probably requires is just for central banks to leave rates at these elevated levels on hold for some time. And as monetary policy makes its way through the economy and through the financial system, it'll slow the economies down and eventually get inflation back down to that 2% target. The central banks are walking this tightrope of not over-tightening, but not under-tightening. And I think the progress in inflation that we've seen in North America in general, both Canada and the U.S. getting inflation down to 3%, has been really positive. We haven't seen that much progress in other parts of the world. Looking to the Euro area, looking at the UK, looking at even Japan now, we're seeing an inflation fight that is still really a crisis in those parts of the world. But here in North America, we've seen great progress. And I think central banks can rest a little bit easier here in Canada and the U.S. now that inflation is sort of down to a simmer at this point.
Well, it is fascinating. Every country has its own story, and on the one hand, some countries certainly still very much in hawkish mode. Then we've been talking recently about, in pockets of Latin America where you're seeing rate cuts now. So point taken. On Canada specifically, I would love to get your recessionary call, because if inflation pressures are easing and the economy is still relatively resilient, there's already been like a big Wall Street firm, Bank of America, that said they're not anticipating a U.S. recession anymore. Jay Powell has said his own Fed economists are not predicting that. But we have our own dynamics in Canada. What do you think the recessionary reality is for Canada at this point?
Unfortunately, I think that ship has already sailed. Getting rates up to 5% and leaving them there for some extended period of time means that more and more households, as time passes, will renew their mortgages or whatever loans they have outstanding at these higher rates, and it's gonna severely dent consumer spending in this country. What we've seen is that only about a third to a little bit more than a third of households with mortgages have renewed in this higher interest rate environment so far. As we move forward in time, more of those households are going to be impacted. And so we're still sticking with our call that we think that the Canadian economy will likely fall into at least a modest recession sometime around the turn of the year. The calculus is a bit different in the U.S. They don't have these 5-year mortgage renewal cycles. Their mortgages are more 15, 30-year mortgages. So consumers that locked in at low rates during the depths of the crisis, or even a little bit before that at the low rates that prevailed after the financial crisis of 2008, 2009, aren't going to see a big increase in borrowing very soon. But in Canada, it's different. We're on this 5-year mortgage interest rate cycle. And so, borrowers will feel the pain sooner here. And of course, we know that there's a lot more household debt outstanding in this country than there is south of the border. So while I sort of agree with the economists that are saying that maybe a recession isn't in the cards anymore for the U.S., it's hard to say that that's true in Canada as well.
Well, and I mean, we saw some of the trend in the Canadian Tire data this morning on consumers stuff. Royce, unfortunately, we're out of time, but you've opened the door to a question about what happens with rates in this country. I mean, if the recessionary reality is staring us in the face, what does the Bank of Canada do with interest rates heading into next year very quickly, in your opinion?
I think the next move is a cut from the Bank of Canada. I think you really have to, tie yourself up into a pretzel to argue that the Bank of Canada needs to raise rates any further. And so I think we can start to see rates coming down in 2024 and into 2025 in this country.
Okay.